Here's a surprising reality. Some of the world's largest mining companies can't grow faster, even with strong commodity prices and billions in capital. Why? Because permitting, not geology, is now the bottleneck. In this video, we break down how permitting timelines are shaping growth for global mining giants like Barrick, Newmont, and Rio Tinto. Why jurisdiction is becoming a critical factor investors are watching more closely, and how early-stage explorers such as Canterra Minerals may be positioned in an advantageous jurisdiction. These insights come from recent industry surveys and real-world project outcomes we track at ValueTheMarkets. Permitting has quietly become one of the most binding constraints in mining. Even well-capitalized producers can't accelerate timelines when approvals are slow or unpredictable. Environmental reviews, social license, and shifting regulations can stretch development by years. The result? Capital gets locked up longer. Project timelines slip, and growth pipelines become harder to forecast, even when commodity prices are supportive. This is why investors are starting to look beyond reserves and grades and focusing more on time risk. If you want clear investing breakdowns like this, subscribe to our YouTube channel now. It helps you stay ahead of structural market trends that shape long-term value. This gap becomes clear when you compare jurisdictions. According to the Fraser Institute's 2024 annual survey of mining companies, Newfoundland and Labrador ranked among the fastest jurisdictions globally for exploration permitting. 86% of respondents expected approvals in 2 months or less. That's significantly faster than many regions around the world where permitting can stretch beyond a year. For early-stage exploration companies, faster permitting can mean more frequent drilling, tighter capital cycles, and clearer project momentum. It doesn't remove geological risk, but it can reduce time-related uncertainty. Now, contrast that with large producers. Barrick Mining faced major disruption at its Loulo-Gounkoto complex in Mali after changes to the country's mining code triggered permitting delays and export suspensions. The issue was resolved only after a large financial settlement. Newmont has a permitted gold project in Peru that remains stalled, with delays tied to social and political factors rather than technical readiness. And Rio Tinto continues to face delays at its Jadar lithium project in Serbia, despite its strategic importance to Europe's energy transition. These examples highlight a key point. Size and balance sheet strength don't override permitting risk. On the other end of the spectrum, Canterra Minerals Corp operates entirely in Newfoundland, a jurisdiction recognized for efficient permitting, established infrastructure, and a long history of high-grade copper, zinc, and gold discoveries. At its 100% owned Wilding Gold project, adjacent to Equinox Gold's Valentine mine, the company has reported multiple high-grade drill results across successive exploration programs. Its fall 2025 drill program confirmed a robust multi-zone gold system with standout intercepts like 31.5 meters at 10.89 grams per ton gold at the Elm Zone and shallow high-grade hits at Alder. Faster approval timelines allow for more regular testing of targets, which can influence how investors assess exploration cadence and execution risk. This doesn't guarantee success. Early-stage exploration remains inherently uncertain, but jurisdictional efficiency can affect how quickly data is generated and how capital is deployed. For investors, that timing difference is becoming harder to ignore. One thing the market often misses is that permitting risk doesn't show up evenly in valuations. Reserves are visible, timelines are not. That's why investors are increasingly paying attention to jurisdictional efficiency, especially in early-stage assets where time to data matters as much as the data itself. Here's where permitting matters most. Early in a project's life, faster approvals don't change geology, but they do change learning speed. More drill cycles mean more data sooner. Later in the life cycle, permitting risk shifts from speed to certainty. For large producers, delays can tie up billions in sunk capital. For explorers, delays mainly affect momentum and funding cycles. Same issue, different impact. Of course, fast permitting isn't a substitute for quality. Strong jurisdictions don't remove geological risk, funding risk, or execution risk. And even in favorable regions, outcomes depend on management decisions and exploration results. But when timelines stretch globally, jurisdictions that reduce friction can change how risk is distributed over time. When investors assess mining companies today, it's no longer just about grades, reserves, or commodity prices. Time matters. Permitting timelines shape when capital becomes productive, and how predictable growth really is. As regulatory risk rises globally, jurisdiction is no longer a background detail. It's a core variable in how investors assess opportunity versus uncertainty. In today's mining market, permitting speed doesn't replace quality, but it increasingly shapes when quality can be proven. To explore this further, learn more about Canterra Minerals by clicking the link in the description to view our exclusive in-depth report. Subscribe to our YouTube channel for more investing insights.